2022. The Deputy Governor will read his statement, and thereafter we'll have a Q&A. So you're all welcome, and thank you very much. Deputy Governor, you're welcome to give your statement.
Thank you very much, Director of Communication. A very good afternoon to you, our viewers and listeners. You're welcome to the reading of the Monetary Policy Statement for the month of December 2022. At the Monetary Policy Committee, that's MPC, meeting held on 7th of December 2022, the Bank of Uganda decided to maintain the central bank rate, CBR, at 10%. Annual headline inflation decreased slightly from 10.7% in October to 10.6% in November 2022, while the annual core inflation declined from 8.9% to 8.8% over the same period. The decline is a reflection of the impact of the previous monetary policy decisions, plus easing annual electricity, fuel, and utility inflation, which has continued to fall after peaking 19.6% in August 2022 and has since declined to 12.2% in November 2022. However, food inflation remains elevated, edging up slightly in November 2022 to 24.1% from 23.5% in October 2022, which is reflecting the effects of the drought. The rise in food prices is temporary and is expected to fade in the coming months. The MPC projects that inflation will continue to moderate, average between 6 to 8% in 2023, and stabilize around the medium-term target of 5% by the end of 2023. This forecast is 2 percentage points lower than what had been earlier projected. The revision in the forecast is due to the dissipating impact of the earlier increases in the global commodity prices, subdued domestic demand, effects of the current monetary policy stance, expected decrease in global inflation, and lower exchange rate depreciation. The Uganda shilling has been stronger than expected, appreciating by 1.6% in November 2022, supported by the tightening of monetary policy, the recent decline in the global commodity prices, such as crude oil, which somewhat eased the pressure on the deteriorating terms of trade, increases in remittances and foreign direct investment in the oil sector. The exchange rate outlook is dependent on global developments, particularly the pace of monetary tightening in the advanced economies, which is expected to slow down. Going forward, inflation trends remain uncertain due to the ongoing evolution of supply shocks. While the factors that have elevated inflation over the past year are reversing, it will take some time before the effects pass through to prices paid by consumers. The upside risks include 1. Potential increase in international commodity prices beyond the current forecast due to possible effects of capping of price of Russia's oil, Europe's ban on Russian crude oil imports, and further cuts in the global crude oil production and exports. Secondly, higher shilling depreciation than currently being projected due to simultaneous tightening of monetary policy by major central banks that could slow down economic activity by more than expected, with adverse effects on Uganda's export earnings. Then tighter global financial conditions and declining international reserves. Thirdly, persistence of supply and logistical constraints to production. Fourthly, the entrenched expectations for higher inflation, which could lead to higher general price adjustments, and lastly, bad weather in the coming seasons, which could damage crops and increase food prices. The downside risks to the inflation outlook include: 1, the materialization of global recession will affect Uganda's trade and financial channels and increase economic uncertainty, impacting on confidence, thereby increasing disinflation pressures. Secondly, lower domestic demand as real incomes decline and as higher interest rate constrain spending decisions. And finally, lower commodity and food crop prices. The domestic economy remains largely resilient to the current external shocks, and is projected to grow in the range of 5 to 5.3% in financial year 2022/23 from 4.7% in financial year 2021/22. This is driven by improvements in agricultural productivity as a result of government interventions, investments in the oil sector, and a rebound in industrial activity. However, this is slightly lower than the October 2022 projection of 5% to 5.5%. Indeed, the high-frequency indicators of economic activity show that economic activity weakened in the quarter to October 2022, and business sentiments fell in November 2022, reversing the upward trend recorded in the previous 2 months. The softening of growth is attributed to the moderation of external demand due to softening global growth, continued adjustments in US interest rates, which have contributed to a persistently strong US dollar, fiscal consolidation, which is imperative to maintain debt sustainability, and tighter financial conditions due to higher interest rates. Indeed, interest rates have edged up while private sector credit extension has moderated in line with the tight monetary policy stance. Economic growth is projected to strengthen in the outer years, but remain below its long-run trend until financial year 2025/26. The growth outlook remains subject to downside risks, including weaker than expected global growth, higher risk aversion in global financial markets amid more aggressive monetary policy tightening in major economies, and a further escalation of geopolitical conflicts that could constrain trade and disrupt global supply chains. The MPC noted that high inflation pressures are beginning to fade, but there are many uncertainties surrounding the outlook that make the path of returning inflation to target while keeping domestic economy on an even keel a narrow one. In these circumstances, the MPC decided to maintain the CBR at 10%. This will allow time to assess the evolving economic outlook. The ban on the CBR remains at +/-2 percentage points. The margins on the CBR for the rate discount and bank rates will remain at 3 and 4 percentage points respectively. The rediscount rate and the bank rate will remain at 13 and 14% respectively. Any adjustments to the monetary policy stance will continue to be determined by the incoming data and in a measured and a gradual manner, ensuring that monetary policy remains supportive of sustainable economic growth in an environment of price stability. There ends the reading of the monetary policy statement for the month of December 2022. Thank you very much for your kind attention.
Thank you, DG. Thank you, Deputy Governor. So now we'll go to the Q&A, question and answer session. But before we do that, we also have Dr. Adam Mugume with us, and Ms. Christina Lupo, who's the Acting Executive Director, Operations. We also have the Acting Director, Research, Sulaiman Nyanzi. So you're welcome, and your questions, I hope the journalists are ready with their questions. So we can begin. Yes, journalists, can you hear me? Okay. This is in the chat. Samuel Setumba, from the chat, we have Samuel Setumba, and is asking, is the world economy headed for a recession, and is it a concern for the central bank? Yes, and do we have others online? Maybe, Deputy Governor, you can take that question.
Thank you so much, Samuel. To the best of my knowledge, I don't think the world economy is yet headed for a recession. But what we're aware of is that there's a slowdown in economic activity, a slowdown in GDP growth. But that slowdown does not necessarily mean that it's headed for a recession. There's a metric of measuring for a recession, and I think that is a consistent decline in GDP growth for 2 successive quarters.
Okay, and then there's a follow-up question. And how is monetary policy tightening elsewhere impacted flight of offshores?
I will just give the overview of that, and then Adam will come in with the numbers. I think we have been discussing this thing very, very often, right from the month of April. What we have seen in the case of Uganda is that the tightening of monetary policy in the advanced economies has led to some portfolios flows reversing out of Uganda. And what we've seen, Adam will give the numbers, but close to about $500 million has actually flowed out on account of that from our government securities. And the impact of that has been exerting pressure on our exchange rate. As these players leave the country, they convert whatever maturities in government securities that they have realized or they have rediscounted back into dollars, and that exerts pressure on the exchange rate. And it partly explains why the exchange rate depreciated over the period of May to July. But Adam, you can add something.
Thank you, Deputy Governor. I think if we remember, like in 2021, end of 2021, offshore government securities holding was around 3.7 trillion and has come down to date to around 2.1 trillion in Uganda shilling. Basically, meaning that around 1.6 trillion equivalent Uganda shillings has exited. And that is really consistent with what Deputy Governor was talking about, almost 500 million exiting. And indeed, as rightly said, this has added pressure on on exchange rate. Now, the question would be, do we see further exiting of portfolio investment with a bit of domestic interest rates also aging up, and also the likelihood that probably the US interest rate hike could be coming to the end? Slowly we are seeing a slowdown in exiting. If you look in the recent past, we see that less than $100 million have exited in the last 3 months, which is pointing to probably towards some bit of a stopping of the portfolio exit. Going forward, probably we expect that if the global situation remains as is, probably we are likely to see that probably the portfolio exit is not a major issue now in months ahead. Thank you.
Okay, thank you. Deputy Governor, we have another question on the chat. Senor Nyitedeo of Business Focus, and he's asking, in light of the anticipated global economic recession in 2023, what advice does Bank of Uganda have to financial institutions, borrowers, and Ugandans at large?
Again, I'm not very sure whether we're going to have a global recession, because we still have a positive growth rate in 2023 that is projected. And so again, this is slowing down of the economy rather than a recession. But with the slowdown in the economy, certainly it has implications for our financial system, in that there will be some effects on the financial system as well, particularly regarding its stability. But the most important thing is that our financial system is adequately capitalized. It is very liquid, and I think it can sustain any adverse implications of a slowdown in the global economy. We've done some stress testing to understand what are the possible implications of this in our financial sector, and what we seem to get out of it, that the system is able to withstand on aggregate the adverse consequences. Now, of course, in terms of the borrowers, again, if we have to make sure that we minimize the adverse effects of a slowing down economy at the global level, I think we need to see how we can focus more on domestic production. And again, as Bank of Uganda, we are urging that our increased participation in value addition becomes very, very important. So if the borrowers could take advantage of increased production and add value to whatever we are producing, in that way we will be able to mitigate to some extent the impact of a slowing economy by producing for our own production, and also for the regional markets if we can. And in that way, we are able to expand even our export base and try to mitigate the impact of the slowdown in, particularly in the advanced economies, by taking advantage of the regional markets.
Thank you, DG. I have another question from the chat. What could be some of the reasons why a peasant grandmother should be concerned about the monetary policy? I'm asking for a normal Ugandan with less knowledge about economics. And this is Mafara.
Mafara, that's a very good question. Monetary policy aims at restoring price stability. And if you're aware, it is the poor, the bottom of the pyramid, who are most hurt by inflation. They are most hurt by inflation because they're the least diversified in terms of financial assets and in terms of their wealth overall. So if we do not maintain price stability, the adverse impact will fall heavily on the poor, and particularly those urban poor. At least in the rural areas, there's a possibility of subsistence. You can grow your food crops and maybe you subsist on that. But if you look at the urban poor who are relying on markets, you go to a market, you are paying rent, there's nothing that you are producing at the subsistence level. So the impact of high inflation falls disproportionately on the urban poor and the poor in general, because they're the least diversified. They don't have the capacity, not even the resources to diversify whatever they have.
Okay, thank you, DG. We have a couple of other questions from the chat. The system seemed to have, there's a disconnection in the system, so we are getting most of the questions from the chat. Another question is, what is the currency outlook in quarter 1, 2023? And then there's also another one. What is the neutral monetary policy rate? And then 3, historically, MPC has trended 3 to 4% above inflation. The current policy rate is actually lagging. Has inflation peaked already?
Okay, I'll ask Adam to respond to that, then I will add something.
On the currency outlook, we believe that in the first quarter of 2023, exchange rate is projected to remain stable where we are, simply because the end of the year normally is associated with high inflows of workers' remittances and also a bit of a slowdown in terms of imports. And with the effect of oil prices coming down, remaining in the range of around $80 per barrel, we believe that currency should remain stable in the, around where it is at the moment. The next question was about the neutral monetary policy. I was trying to see whether in the statement we talked about neutral monetary policy, but we never mentioned it. We just said the monetary CBR remains at 10%. Now, the neutrality, usually when we don't change any monetary policy stance, in other words, if we maintain the CBR as is, sometimes it can be related to say that yes, monetary policy is neutral. We have, in other words, we have looked at risks, both upside and downside towards inflation, and we believe that no change in policy stance would be associated with, in a layman's language, can be taken as a neutral monetary policy stance. But if you are to go into technicalities, which I don't think is intended for this discussion, then neutral monetary policy stance would be looking at full employment level and also monetary policy, inflation being around its target range. Those are the questions I picked. And
The third one, if I can repeat it, historically, MPC has trended 3 to 4% above inflation. The current policy rate is actually lagging. Has inflation peaked already?
yes, we believe that where inflation is in this quarter, inflation, given the outlook, given, assuming the usual jargon we normally say in economics, assuming all things remain constant, we believe that inflation has peaked in this quarter to December. Therefore, meaning that, and I think the statement clearly says, inflation is projected to decline to between 6 and 8 in 2023, which means that moving from 10.7 or so to 8 means that real inflation has peaked. And therefore, the positivity of we are talking about in terms of the difference between monetary policy, CBR and inflation, we believe that by the end of the year, obviously, it will be a positive. You already put it 3% point above the CBR.
Okay, and maybe to add to what Adam mentioned about the stability of the currency, again, this is subject to a number of upside risks because it all depends what's going to happen to the interest rates in the advanced economy central banks if they choose to hike because of some inflationary expectations. Then we could have some deflationary pressures that could come. If we have a situation whereby the global oil production and the exports are affected, by other factors, maybe through a reduced output and exports as well, then we could have higher oil prices. And that has, of course, impact on the exchange rate. But what Adam is saying is that if everything stays as it is now, then we expect to have a stability in the exchange rate. And of course, stability does not mean to say that the exchange rate is going to remain at a particular level. All right, I think it will fluctuate around some levels, but in a manner that is not disruptive. And then, of course, again, like Adam has mentioned about the CBR and inflation, I think when we determine the CBR, we are forward-looking. We are saying that the CBR that we are announcing is consistent with delivering an inflation objective in a future period in time. So you might find that the CBR today is lagging the actual level of inflation simply because that is the CBR that is required to deliver inflation of 5% over a given period of time.
Okay, thank you. And then 2 more questions. What is the reserves outlook into Q1 of 2023? Is there a plan to build these? And then Senyonis Tadeo thanks Deputy Governor and asks, what's BOU's general economic outlook for 2023?
Okay, thank you so much. On the reserves, let me be very, very clear here. As a result of the global tightening of the financial conditions occasioned by the increases of interest rates in advanced economies, what we have seen is that, generally speaking, there has been an outflow, a net outflow of capital from emerging and frontier economies. So capital has flowed out of emerging and frontier economies. And Uganda being a frontier economy, we have witnessed that outflow of capital. And given that outflow of capital, there, of course, are the variables that are exerting pressure in terms of the outflows as well. So we are having things like debt service payment, which is calling on our reserves. So our capacity, therefore, to buy reserves or to buy foreign currency from the market has been constrained by the capital outflows, which is affecting emerging and frontier economies. But at the same time, we are having pressures to spend money on servicing government debt. So we have seen a reduction in our reserves from levels of about 4.6 now to about 3.7. But also, let's be careful here. The 4.6 billion, the 4.6 billion that we had recorded earlier on could be treated as an outlier, because when we were able to build reserves of 4.6, you needed to look at what were the prevailing conditions. At that time, there was significant inflow of capital into Uganda at a time when the interest rates in the advanced economies were near zero, and yet the interest rates on our government securities were very high. So there was significant inflow of this capital into Uganda, particularly the portfolio players. And Bank of Uganda was able to buy close to $800 million from the market. This is a big number. So it was supported by those inflows. But now, as those inflows have reversed, and when we bought the $800 million, that's why we were able to build up our reserves to that level. But now that monetary policy is normalizing in the advanced economies, we've seen these flows reduce. So our capacity to build reserves has kind of like been constrained, and is being constrained at a time when the debt servicing is increasing. So that means that our reserves have come down to about the 3.7 billion US dollars that we have right now. And in terms of the month of import cover, what even exaggerated the month of import cover earlier on was that during the time of COVID-19, the import levels were very low. So you are having a time when you are buying more in terms of building reserves, your import levels are low, occasioned by COVID demand for less imports, and therefore exaggerating the month of import coverage. Now, what's happening is that your reserves are not are running down on account of the factors I've mentioned, but the import levels are picking up. So you find that there's also an exaggeration in terms of what is happening in terms of the month of import coverage. So those are some of the issues that we need to be aware of.
Okay. There was the last one. So you've answered the outlook, general outlook.
Yeah.
Okay. So I think this brings us to the end of the Q&A. But before I close, Deputy Governor, we'd like to acknowledge the presence of, in our virtual press conference, the presence of the Chairman, Board of Directors, Public Sector Foundation, Private Sector Foundation, Mr. Humphrey Zay, and the board member of the same Public Sector Foundation, Mr. Badru Tege. Thank you so much for joining us.
Thank you for joining us.
And then the statement will be on the website and will be shared with the media after. Okay, thank you so much.